Time to talk personal finance thanks to our partners Forsyth Barr. This week we look at investment risk and how to understand it. Mark Richardson is investment advisor with Forsyth Barr with us this morning. Good morning, Mark.
Yeah, morning, mate. I think the first thing with risk is I don't like the term. I think
you're averse.
It's well, I'm not averse to risk actually. I think people should perhaps, most of us are in a better position than we think and could take it a little bit more. I like to sort of view it as, rather than risk, which is quite scary, just a measure of volatility, because that's effectively what it is. And you can't avoid it. Every investment has a degree of risk, even those ones we think are risk-free, like government bonds or term deposits with major banks. They still carry some sort of risk. They're exposed to some sort of risk. It could be interest rate fluctuations. It could be inflation eroding the value of those returns. It's just, you got to look at risk as, or volatility, let's say, as the trade-off for return.
Yeah.
So, risk premium is put on an investment, so the volatility around that investment suggests that you take a little bit more risk, you can hopefully get a higher return when things go well, but of course you have to accept that things can go in the other way as well.
Which is why when you're my age, for example, you might take more risks.
Well,
when you're your age with your investment, you might not.
True.
Because you need to draw down sooner.
Yes, but I know what I'm doing, Ryan, and you don't.
That's true.
So maybe that evens things out, doesn't it? But that's a good point, actually. Probably the primary two ways to manage a risk are diversification, first and foremost. So spreading your investments across different asset classes, different sectors, different geographies. So each individual asset might have the same degree of volatility, but as a unit, you can smooth that right out. And the other thing, you're right, it's time. So if you've got more time, you can probably expose yourself to a little bit more risk, but it also depends on what your tolerance for risk is. You don't want someone with you who might have a ton of time, but they're just not the type of person that can deal with the volatility that comes with maybe being in 100% in growth assets or more volatile assets, and they can't sleep at night. If they can't sleep at night, you're lying in bed worrying about them not sleeping at night.
Totally.
From the point of view of an advisor.
I think I've asked you this before, but is there a general rule around diversification of a split? You have 15% here, 15% there, a quarter in property. What's the rule?
I think you've also got to look a little bit deeper than that as to the types of, let's say you've got a classic balance 60-40 split, 60% of growth assets, which let's view them as equities, shares, and 40% of fixed interest. You've also got to look at actually what the spread within those particular asset classes are as well, because there are less volatile equities and there are more volatile equities. So it's not just as simple as going, okay, we have a 60-40 spread for a balanced investor. You've also got to look at what you might need the money for, when you might need the money, those types of things. So there is a few different moving parts that you need to be aware of.
A lot of it, when you're trying to refashion risk as volatility, which it is, it's the same thing.
Yeah.
But it's a psychological thing for people, isn't it? Just the idea of it's one thing to leave your money in the bank and for inflation to erode it, and you're not actively making a decision to invest it or not invest it, but you're still getting hit. Whereas if you have to make a choice to put your money somewhere, you suddenly get paralysis.
Well, you do get very nervous, and people need to realise you get $100 in the bank. It's not actually worth $100 generally in a month's time.
Exactly.
It's actually, the $100 is still there. You look at the balance, I got $100.
Yeah.
But it might actually, that's the erosion of inflation risk. Now, there is nothing, and when you come to me, Ryan, and don't come to me and go, I want 20%. I hear you can get that in the market. So I say, okay, well, let's have a look at something that potentially over 5 to 10 years can get us that sort of return. And then all of a sudden, next week, one of your assets goes down and you start to worry and you're ringing me up and getting me on the phone.
Yeah.
It's just, if you're going to have risk, it's tolerance for volatility. You have to be able to stomach or have to have a goal, a time horizon to be able to weather that volatility.
Yeah, because you don't want to have a financial advisor and a psychiatrist.
Well, in a way, I feel like at times we're amateur psychiatrists. Look, we want to go what we call northwest. There's a good advisor is going to get you a good return for an acceptable level of risk, and you want to sort of get the highest return you can for the lowest risk, but you cannot avoid risk.
Appreciate you coming in this morning, old boy, investment advisor, Forsyth Barr. That is Mark Richardson, and we talk personal finance every week thanks to our partners at Forsyth Barr.